Hello and welcome, everyone. This is Dr. Anna Brutlog. I'm the Associate Director at Pet Poison Helpline, and I am your host, one of your hosts, I should say, for today's webinar. So thank you so much for joining us. We have been, for those of you who have been attending in the past, we've been partnering with AVMA Life to really focus on some webinars that are not necessarily toxicology related. And we have done several webinars on issues involving wellness of all sorts of stripes, mental health, wellness. Today we're talking about investment because financial wellness is certainly something that a lot of veterinarians think about. And if you're like me, it might not be something that you like to think about a lot, but I think it's imperative. So we're trying to bring a variety of webinars and a variety of kind of wellness related topics to our audiences. So again, thank you for attending and welcome. If you like, a couple of just housekeeping tips at the beginning here, you're welcome to download or print off today's PowerPoint presentation. You'll find a link to that in the handouts section of your GoToWebinar dashboard. So you can feel free to go ahead and access that now. Also, just so you know, today's webinar is being recorded. So if you have to leave in the middle because you're running late, or you want to watch this again, or you want to recommend it to colleagues, either way, this is being recorded, and there will be a link to it on both the Pet Poison Helpline and the AVMA Life website. So we'll get further up. You'll see an email coming out in the next day or so with a link to that website. Just so you know, regarding CE certificates, so this is not a race-approved CE. However, we still will be issuing CE certificates so you can apply for CE to your own individual board. And if you're watching, with respect to that, if you're the one who's registered and you've logged in, you will automatically receive your CE certificate. Now, if you're watching in a group, what we need you to do in order to make sure everyone gets their own CE certificate is to send us an email by 1 o'clock Central Time tomorrow, the strict deadline, and let us know the names of the attendees and the email addresses of the other attendees in your group. And we'll have more instruction on that at the final slide of this webinar. So without further ado, we are going to go ahead and get started. I am going to first just introduce Pet Poison Helpline very quickly. For those of you who aren't familiar, Pet Poison Helpline is a 24/7 animal poison control center. We're based out of lovely Minneapolis, Minnesota. We actually have a human and an animal poison control center side by side. So as you can see here, we have an extremely large number of vets and certified veterinary technicians on our team. It's great folks. I can't say enough about the team that I work with. And in fact, we are in the moment, we are hiring veterinary technicians. So if you're interested, I would just head to our website, petpoisonhelpline.com, and look for the careers. Look for careers. Anyway, as far as our veterinarians go, we have a broad base of expertise, including vets boarded in toxicology, of course, as well as emergency critical care and internists. So our consultation fee is $59. That includes unlimited consultation. So if you have to keep calling back about the same case, there's no additional fee to call back and do so. That also includes us sending a fax or an email of the case report directly to your clinic. And then the other thing I want to mention about Pet Poison Helpline is we really see ourselves as an educational center. Its education ranks very high within our mission, and these webinars are an example of that. So we also have a lot of educational materials for clinicians, for vet clinics to use. They can put such materials on their website, put it on social media. We have videos geared towards pet owners to help them understand the risks of chocolate poisoning or lily poisoning, etc. So if those things are of interest to you, please send us an email. We'll get you set up with more info. And at this point in time, what I would like to do is turn things over to Libby from AVMA Life. She's going to talk a little bit about AVMA Life and then introduce our speaker. And I will see everyone at the end. So take it away, Libby.
Great. Thank you so much for that introduction. And thanks to all of you for joining us today. I know everyone is very, very busy, and so we're glad to have you join this. I think when we talk about wellness and well-being, as was alluded to earlier, it doesn't just take into consideration your own personal health and well-being or that of those in your practice, but also financial well-being. And that's why we've asked Mark to join us today. First, let me just touch base on AVMA Life. We are, as our name implies, we do offer life insurance to veterinarians, but we really have expanded that beyond just life insurance and really to cover the whole individual from an insurance perspective. And so a couple of things that are new to our program, which really will touch all of those that are in practices besides just the veterinarian. Something we're rolling out right now is dental and vision plans. Also, we have life and disability coverage, not only for veterinarians, but also for those in the practice. So for the staff members, whether you're a technician, office manager, what have you, we can make that available because really what encompasses our personal life also goes to our business life as well. The other thing that we have that we've really tried to address, and it's very relevant to today's discussion, is student loan refinancing. And as those of you that are veterinarians, and even those that aren't on the call today, know the veterinary student debt is very, very high in our country. We've tried to put some programs in place that really help individuals deal with that. Not so that we're suggesting anybody get more loans if they don't need them, but really how to deal with the high cost of veterinary school and how to help manage those costs. There's other things that we do, other insurance coverage, of course, but probably the biggest news that I can share with all of you is that we now have what we call our member advocate available. And that's really someone that can help individuals manage health care. This is open enrollment season right now for many people who are looking to change their health insurance for January 1st. And so our new member advocate is on staff, and she can help individuals kind of know how to manage through the whole insurance world of health insurance. If there's high cost, how to manage those costs and work through the expenses, at least to be able to know what to pay and what not to pay, as well as kind of manage through the whole Medicare process. So I guess what I'll leave you with is that first and foremost, we're not just life insurance. And if there's questions or needs, we're happy to address those. But we're really trying to help individuals manage their whole well-being, not just their health. So with that, if you wouldn't mind going to the next slide, let me introduce our speaker for today. So Mark McKinley is with a company called William Blair. Mark's responsible for relationship management and client communication on a wide variety of taxable and pre-tax client relationships. And really, I first got introduced to Mark because his firm manages the financial investments of both AVMA Life and the AVMA PLIT, the liability insurance. So we've worked with Mark and his firm for quite a while now, helping manage our own investments for our organization. Before joining William Blair, Mark was a portfolio manager at Atlantic Trust for over 14 years. And then previous to that, he worked at Northern Trust for more than 8 years. Many of that time was as a portfolio manager. A graduate of Denison University in Ohio. He has a Business of Arts, in economics and political science. And then he got his MBA at Northwestern University, Kellogg Graduate School of Management. So Mark has been in the industry for quite a while, has a lot of experience, joined William Blair in 2012, and is involved on a professional level at many different associations. So with that, Mark, I will turn it over to you, and you can give everybody, ourselves on the call, an introduction to investing and some things to think about.
Okay, well, thanks, Libby. And I just clicked a button, so everyone out there should be able to see me now. And hopefully that is coming through just fine for you. So first of all, welcome to the introduction of to investing. Really appreciate the opportunity to speak to everyone today. We have a great relationship with AVMA, which we very much value, and so this will be hopefully some fun and good education on investing. So before I dive into the actual presentation, I'll go to the cover page real quick here. I will try to go to the cover page. There we go. So here's the cover page. But before I get into the meat of the presentation, I just want to go over a couple things just in terms of setting expectations. I am going to do this presentation with the assumption that people really don't have a whole lot of experience in investing. So, it is an introduction to investing. So we're going to stick to the title, keep it as an introduction. For those of you that do have some experience in investing, there are some slides in here too that do kind of get into the weeds. So I won't explain them in too much detail, but hopefully you're going to be able to pick up a couple nuggets as well. Hopefully have some reminders that will be helpful for you too. And then speaking specifically to those that are new to investing, this is a short amount of time to cover a lot of material. And if there are things that I'm talking about and you're not quite following, absolutely don't worry about it at all. We hope to have enough time at the end for a couple of question and answers, but you don't have to figure all of this out today. In fact, I would tell you that there's two main big themes that I'm going to be talking about. One is, in terms of investing, start early. It's really, really important to start early, and I'm going to show you some slides that will give you some evidence to the fact that that is the case. And then the other thing is, once you do get started early, stay invested and don't try to be bouncing in and out of the market. So if you come away with those two big themes, which is start early and stay invested, then for the long term, I think this is going to be well worth your time. And that's why you don't have to make sure that you know every single detail that we're going to go over today. Also, I would just pat yourself on the back for choosing to participate in this webinar. I really think that just knowing prioritizing the importance of finances, your personal finances in your life, is really, really important in terms of being able to set yourself up for success long-term in the future. So I think it's great that everyone is participating. With the technology, I can see the number of people, and we have quite a few folks out there, so that's great. And then lastly, before we get into it, I would just say that I do recognize that this is kind of difficult. So the question would be, how can I possibly ask some of our younger people to be setting aside money for your retirement when maybe you just got out of school? Like Libby said, that you're working off of those student loans, and when you look at the amount of expenses you have, it's really, really difficult. And so I do recognize that, but again, we're going to look at some material that will show you that it really is great and important to start getting invested. So certainly there are things that would prioritize ahead of this, like we don't want you to have a whole lot of credit card debt. If you have any credit card debt that's outstanding, certainly encourage you to see if you can work that off, because that's really high cost money to you. But just getting started with your investments, setting whatever it is that you can afford in the beginning, and then as your career progresses, you'll hopefully have a little bit more money to increase the amount that you're saving on a monthly or annual basis. That would be, sort of the recipe for success here. So with all of that overview, what we're going to do is, as many of you that have participated in these in the past know, there's poll questions. And so we're going to hit you with a poll question right off the bat. So introduction to investing, and I'm already hitting you with the question, but I thought that might get your brain cells working a little bit. So let's give this a try. So I'm going to go to our poll question. So the poll question is, which of these two investments do you think is worth more after 40 years? Again, which investment is worth more after 40 years? And the first investment A, you invest $3,000 per year for 8 years, for years 1 to 8. So starting now, the next 8 years, you're going to invest $3,000 a year, and you're going to earn a 10% return every year for 40 years. Investment B is that you invest $3,000 per year, and you're going to do it for 32 years instead of 8, but you're not going to start until year 9. So no investments for the first 8 years. You're going to start at year 9 and then invest $3,000 a year for 32 years. And again, you're going to earn that exact same return, which is a 10% return And the question is, which of these will be more valuable after 40 years? And this is where Anna takes over, and she pulls up the full question for you, and you can go ahead and vote on it.
Excellent. Well, I definitely see some answers coming in, Mark. This is wonderful. I'll leave it open for a few more seconds here, give everyone a chance to vote. Remember, investment A is $3,000 per year for 8 years, year 1 through 8. Investment B, $3,000 a year for 32 years, years 9 through 40, 10% return. Okay, looks like we've got some responses. I'm going to close the poll in 5, 4, 3, 2, 1. All right, let's take a look at those responses.
Wow, that's so it looks like the response rate, I don't know if, do we have percentages there, Anna, or it's clearly overwhelmingly at investment A?
Yeah, it's 81% voted for A, 19% for B.
Okay, so 81% for A and 19% for B. So one of two things is happening here. Either you've figured out which way I was going to be leaning in the question, or we have a really smart audience. So I'm going to go with a really smart audience. How about that? But I do have another slide to kind of give you some details of this question. Oh, I got to click on this, and there we go. So again, here's just here is the actual result. So if you were to, investment A is the bar on the left. If you were to invest that $3,000 a year, again, that's $24,000, and at a 10% return, you would wind up with $796,000 plus after 40 years. With investment B, $96,000 investment, but by waiting until year 9, you're only going to wind up with it's still a big amount, but you're going to wind up with $663,000 plus. So that $3,000 investment for those first 8 years, pretty amazing. The compounding effect, and that's what this is all about. Is you're seeing the power of compound annual returns when you look at this. So then the other thing, though, that I want to make sure that we understand here is $3,000 a month would be, or $3,000 a year would equate to $250 a month. And so right now you may be in a position where you're thinking there is absolutely no way I have another $250 a month to be putting aside. So my point here would be that this is proportional, right? So if you were to say, instead of investing $250 a month, if you invested $100 a month, then $100 would be 40% of $250, which means that your almost $800,000 would be more like $320,000. Sorry, that was a lot of quick math. But the point being, $100 a month under these numbers would produce about $320,000 at the end of 40 years, which is by no means inconsequential at all. So again, that's the message here, which is whatever you can afford to do, that would be what's important to try to get going on. Okay, so that was one of the big themes. I want to make sure that we're set on that is starting early. Okay, so we will press on though, and see if we can get the page to turn. There we go. All right. So we're going to take a step back now. So now we've convinced ourselves that we do want to get started early, but the problem is that maybe we don't know much about investing, and even if I'm going to set some money aside, what on earth am I going to do with it? How do I actually invest it? So the first thing we're going to talk about here is just some different kinds of investments that potentially would be available to you. And in here we have 4 different categories listed on the slide, those being stocks, bonds, real assets, and commodities. And so they're pretty self-explanatory, but stocks are investing in companies. So if I go out and buy 100 shares of Apple, I am actually an owner in Apple as a business. Bonds would be, when you buy a bond, you're actually lending someone money. So you're hoping to get your interest on your bond and then your money back at maturity. Real assets, the example would be, owning your house, or maybe if someone had an investment property, a rental property that they were using, that would be a potential investment. And then commodities would be more like a natural resource, whether it be oil or gold or something like that. But I think if I go on to the next slide, this will, it's a good way to kind of show this story. So, you can see that under different investments, there are different possible outcomes, both from a return perspective and from a risk perspective. So let's start all the way on the right here. With common stocks, that is the same thing as equities. And when you own stocks, again, you are an owner. And so as an owner of a business, you can kind of think of it that way. As an owner of a business, just like many of you may have your own business, there's great benefits that can come to that, but there is more risk that happen with that too. And because there's more risk, there tends to be more volatility in that investment. So you just have to be prepared and aware that when you're investing in common stocks, that you should expect over time that your return's going to be greater, but you're going to have a little bit more of a wild ride with your balances over time. And then if we go all the way over to the left, a treasury bill is just a short-term bond. So it's a bond issued by the U.S. government that's going to mature within the next year or so. And so that is an investment that doesn't carry a whole lot of risk at all. The Treasury, knock on wood, has never defaulted on its obligation. So people have always gotten their money back for that. But because of that confidence that you can have in getting your money back, the return that you're given is really not that great. So this is the balancing act that we're always thinking about when we're thinking about our investments, is what proportion of our portfolios do we want to have in risky assets versus what proportion of our portfolio do we want to have in non-risky assets. So it doesn't have to be an everything or nothing. You don't have to either be 100% common stocks or 100% treasury bills. It can certainly be a mixture along this continuum. So that, I think, is enough on that chart. Let's go on. Now, this next chart I am not going to dive into in a huge amount of detail, but it is a chart that's obviously very busy, first of all. But it speaks to the concept that I would like you to take from this is that again, that it's proportional. So the more you invest in stocks, which would be, and what you're looking at here is a chart that along this line of the connected dots, that is 11 different possible portfolios that you could be invested in. And the portfolio 11 would be the most risky and would have, in this case, 100% equities. And then it goes up all the way down. As you move down this line towards portfolio 1 and 2, you would have less and less equities. So you can see from the way these lines are drawn up, the more equities you have in your portfolio, the higher is your expected return. But you also go out on the right side of this standard deviation. Just think of that as a measure of risk, so that the more equities you have, the more risk is in your portfolio at the same time too. So one of the keys is to just kind of try to make sure that we understand our own risk tolerance and figure out where along these lines we want to wind up. And there's a slide later that I'm going to show you, which kind of gives you an idea of, on average, where we think, based on people's ages, where they should be with their asset allocation. But we'll take a look at that in a little bit. Okay, so moving on, again, kind of maybe taking a step back here, as we start to think about it, again, so sort of in review, we've decided that it's important to start early and that we want to get going on our investing. So, how do we do that? How do we figure out, if there is a little bit of money that we can set aside every month to to start building an investment portfolio. So obviously there's a couple ways we can think about this, but just being very cognizant of your own finances, I think, is part of the trick here. So we can break it down in terms of thinking about goals, and we can look at maybe short-term, medium-term, and long-term goals. Short-term goals would be, things like reducing your debt, obviously working on those student loans. Maybe that given your job, you're going to have to buy a new car at some point. Maybe you have a wedding coming up that you need to plan. And then medium-term would be things like buying a house, starting a business. Maybe you're planning to have some kids. I know firsthand they're expensive. And then long-term, you're thinking about retirement, vacation home. Maybe you want to have some charitable giving in your long-term portfolios. So obviously these dollars that we're talking about are more retirement dollars. They're long-term dollars. So it's just a matter of trying to get a balancing act so that each one of these gets a little bit of action in terms of where your budget is. And so in terms of like the budget, I think the important thing is to really make sure that you are following your money and knowing what it is that you're spending on. So the money coming in is usually a little bit easier. It may not be steady, but you know where the sources of income are. You have a pretty good idea of what that is. But a lot of times people don't have as good a grasp on, exactly what they are spending on. So while it may be daunting thinking about, how can I come up with some dollars that I'm going to set aside for my investment portfolio, if you get in there and you understand where your money is going out, that's where you can maybe make a couple trade-offs here and there and wind up with a good answer. And then ultimately, once you've done all that, it's just a matter of prioritizing and figuring out, what it is that you need to do right now to be able to save a little bit for the future. And ultimately, certainly the biggest thing, the biggest advantage that our young people have is they have time, right? And so we saw that chart already over the 40 years, what happened to that investment. And so time is a really, really important advantage that you want to take advantage of. Okay, and then if we go on one more chart, this is kind of emphasizing a couple of the same things. We talked about goals and objectives. Risk tolerance, I want to spend a second there because I am going to, like I say, show you some thoughts about, being relatively aggressive when you're young, that you have enough time so that you can live through the bad markets, because certainly there are going to be bad markets. This has been a great market this year. This has been, a lot of fun if you have an investment portfolio to see the value of the investments rising. But we certainly are very confident that unfortunately it's not always going to be this way. And so it is important to understand your own risk tolerance. So whereas I might say that as a person in your 20s, you can afford to be a little bit aggressive because you have enough time if the market goes down for your portfolio to come back. That doesn't matter if you know yourself that you just can't bear to see a statement where you've lost any money. Because if you invest aggressively and then you have that personality that all of a sudden the market starts going down, well, that's a recipe for then pulling your money out when stocks are really low. And that's exactly what you don't want to do. You do not want to be jumping out of the market after the market has not done well. Because historically, every time we've run into some of these problematic markets, and we've had 2 of the 5 worst in the last 17 years, every time that's happened, those that have kept their investments in the market longer term have been rewarded. Okay, so let's go on from there. And again, this is just another view into how we saw on that one chart that over time, stocks have done a little bit better than some of the other asset classes, especially bonds. We focused a lot on stocks and bonds so far. And so what you have here, it's kind of a very detailed chart, but the top 4 outcomes here are all equities. So starting from the beginning, if we go all the way back to 1982, so year-end 1982, we start with $100, and then the question is, what would that $100 be worth through February of 2015? And so we have the answers here in this chart, and the important thing is not exactly what the exact answers are or which kind of stocks did better than others. I think the most important thing is to notice that the value has gone up quite a bit. And I apologize, somehow I got this chart in here. I had one updated through October of 2017, but the message is exactly the same. So not a big deal that this is a little bit dated, this chart. So at any rate, what we see here is if you invested $100 and you put it in mid-cap stocks, and mid-cap stocks are just kind of, think of them as medium-sized companies, that investment would have returned 12.8% per year, and over this 13-ish year time frame, you would have wound up with $4,860. So that's a pretty amazing return over this time frame. Did I say 13 years? It's a lot longer than that. Sorry about that. That's 33 years that we would be investing over that $100. But the other thing to notice here that's really important is if we look at those top 4 lines and you look at the pattern of how they got there. And so that's where this chart is helpful in kind of seeing some of the volatility. So again, our 2 really bad bear markets over the last 17 years have been 2000 to 2002 and then 2008, 2009. And it's especially visible on this chart when we look at 2008, 2009. We can see that all of the equity lines went down very, very steeply. So if you look at, sort of peak to trough, that 2008, 2009 market, the S&P 500 went down over 50%. So it was a very, very painful time to be a stock investor. But again, had you stuck in there, what we have seen subsequent to that is stocks have come back, and they've come back in a very, very strong fashion, so that it has paid to be a stock investor. And then the other lines on this page, except for the very bottom line, which is just a measure of inflation, the other 3 lines are measures of fixed income and what those would be worth. And so what you see there is that those lines aren't nearly as volatile as the equity lines. Now, the one thing, this is kind of getting in the weeds a little bit, the long-term treasury line, which is not that far off of the stock lines, I would caution you to draw too much out of that, just because we have been over this time frame in a very long market where interest rates have been going down this entire time period, which is very helpful for bond investments. But now that they've already gone down, the ability of bonds to have these kinds of returns going forward is going to be somewhat difficult. So don't read too much into where that long-term treasury bond line is, I would argue. Okay, so that was a lot on that page. Let's go on, and we are going to do our next poll question. So a lot of me talking, so let's do another poll question. And so here's the question. If you invested $10,000 in the S&P 500 on December 31st of 2001 and invested it to 12/31/16, you would have earned an annual return of 7.28%. And your $10,000 would have been worth $28,698. If you missed the best 10 days of those 15 years, what would be the value of your initial $10,000 investment? So you're invested for 15 years, you only missed 10 days of the market in those 15 years, what would the value of your $10,000 be after those 15 years? And here Anna is going to take over.
Okay, Mark, let's get ready and launch this. All right, everyone, go ahead and vote. Excellent. I see lots of responses coming in. Perfect. Well, while everyone is voting, I will just say some people have asked some excellent questions too that we'll discuss at the end. So if you do have, again, there'll be some time for a Q&A at the end of the session. If you want to put in a question in writing because you're thinking about it right now, feel free to do that, and then we'll address those later on. So I'm going to close this poll. It looks like we're almost done here. I'm going to close it in 3 seconds. 3, 2, 1. Okay. Take a peek.
All right. So we have, I can't see the percentages, Anna. Can you just give those to me?
I can, yes. So the first A, we have 19%, B, 28%, C, 31%, and D, 22%.
Okay, so this question proved to be a little bit harder than the first one. We have a pretty even distribution here, and the actual answer, believe it or not, is D. And I recognize it is almost hard to believe, but if you just missed those 10 best days of the market in that 15-year time frame, your return would have basically been cut in half, is the answer. So, so very surprising. And I have another chart here that will give you some of those details. So here is, here's the study. So you can see what I picked on here was just missing those 10 days and getting your return basically cut in half. And then it also, this chart shows you what would happen had you missed the best 40 days. Had you missed the best 40 days, then your return actually would have gone down 4.63% a year on average, and you would have had about half of the money that you started out with. So there's a couple implications. I mean, part of this is sort of fun because it is almost inconceivable to think that someone could be so bad at timing the market that they would only miss the best 10 days of the market over a 15-year time frame. So the likelihood that this would be the result is really not that great. And certainly the likelihood that someone would miss the best 40 days is not that great either. But there is, I think, an important message here, which is to say that if you think that it is going to be easy to be jumping into the market and out of the market to sort of protect your money after you've made money, and then you're going to get out of the market and you're going to wait till it gets low and buy back in, that is very difficult to do. And it's a recipe for people making really bad investment decisions. In fact, as I was coming in today, I was thinking, I was like, oh, there's a slide I should have had in here. I should have found this slide. But there's a slide, and I haven't seen this in a long time, but a long time ago, I saw this study, and it was almost tragic. It made me want to cry. It showed what the average return of a mutual fund investor that invests in equities actually is. And the problem is that the general public gets scared out of the market at the wrong time, so that, you know, those S&P 500 returns, those really good, great long-term returns that we saw, most investors don't get those because they make bad timing decisions, because they get out and they think that the market is going to go down more, and then it goes the exact opposite way. So so beware of the cocktail party. A lot of times you're at a cocktail party, you will only hear from people about the good investments that they made at cocktail parties. You will not hear about the bad investments that they made. And unfortunately, there are a lot of bad investments. So just sticking to your plan is historically been a recipe for success. And so that's what we're suggesting that is probably the better route here. Okay, so we'll go on here to the next slide. There we go. Now this slide is, if there's a busy slide, this probably wins the award, right? This is a lot of information on a slide. But so I just suggested that, you know, what you probably want to do is kind of stick to your plan and stay invested. But this is, again, back to how are you going to invest, especially if you think about on the equity side. So there's a lot of different flavors of equity, right? I mean, there are, you know, we've kind of looked at some of these risk charts, and a lot of these risk charts assume that we have a pretty well diversified portfolio. And that's not always the case. Sometimes people have a single stock position that represents a big part of their portfolio, and that actually adds another level of risk. So the question is, if you're going to stay invested over a long period of time, what is the best way to do it? And the best way to do it, we think, is to mix up those investments, which is called diversification. You don't want to have all of the same kinds of investments. So what you're looking at here, just to explain this page, is a lot of different categories of possible investments that you could make. There's both equities on here, and there's also fixed income on here. But sort of the extreme one, the best return over this 15-year time frame was emerging markets. And that is depicted by, there's a couple different kinds of colors of pink, so I'm going to call that medium pink. But if you look in the upper right-hand corner, it shows you that the average return on emerging markets over this time frame has been 17.3%. So really strong. But where the color coding is helpful is if you follow that color through this chart, and you don't have to do it right now, but you would find that there's years where literally the emerging markets have been the best and years where they've been the worst. So for that high return, you've had to deal with a lot of volatility. And then it kind of goes down from there between, depending on if you're investing in large cap stocks or small cap stocks. But the answer, probably the best answer here, is to have a little bit of a mixture of all these. So the emerging markets, with the volatility, you probably don't want to have 100% of your portfolio invested in emerging markets. But does it make sense to have a small slice of your portfolio in those, given the fact that those economies are not as developed as the rest of the world, and it kind of makes sense that they would have more growth? So yeah, it probably does make some sense, but it has to be a balance. But by incorporating a number of these, what's going to happen is it's just going to smooth out your return a little bit. You won't have to have this kind of return. You'll have a smoother return. And so, so you can kind of see when the emerging markets were bad, there were other things that were a lot better. And so you just don't necessarily have to have that volatility that would come from investing in any one of these categories, much less the example I started with, which is having the volatility that would come from having just one stock in your portfolio. That's the ultimate, risky position, obviously. Okay, so moving on that chart. Okay, so here is the chart that I've referenced a couple times, and this, again, kind of gives you an idea of where we would think would be probably, on average and appropriate for different age categories. So as you can see here on the far left, we have a 25-year-old that is heavily invested in equities. And again, the theory here would be that this 25-year-old has the capability that if we run into one of those nasty bear markets, as long as they stick to their plan, they have plenty of time to recover. And over time, as an equity owner, and think of that concept again, when you're an equity owner, you're the owner. And by investing in the stock market, you don't have to invest just in one business. You can invest in a lot of businesses. And certainly there's going to be some that don't work out. But what we found on average is that if you're well diversified, that the whole pie has gotten carried up. And so that's why we're interested in having that younger person be a bigger equity investor. And then we go to the 45-year-old. And with the 45-year-old, this may be a little bit surprising in that you can still see that more than 3/4 of that pie is invested in equities too. But if you think about it, I mean, the 45-year-old has, they may have 30 more years of work, maybe it's 20 years of work, whatever it is, but then they have a retirement on top of that too. So they too have a really long time horizon that they potentially would be invested. And then finally, it's the 65-year-old, and this may be perhaps the most surprising slide, because even at the 65-year-old, we have with more than 50% equities. And so why is that the case? Well, back in the 1950s, retirement may have only been 10 years or so. So you could go to a much more fixed income oriented investment. But with a 65-year-old today, because of medical technology, those retirement timeframes have elongated a lot. So if the 65-year-old gets really, really conservative, the problem is inflation. that their dollars are not going to be worth as much in the future as they are today unless they have some of those equity investments that have a little bit higher return that will offset inflation over time. Again, though, I will reiterate that this is sort of all else being equal. What trumps this is knowing yourself. And so if you know that you can't tolerate that much in equities, then you shouldn't have that much in equities. It's just that plain and simple. Okay, so enough on that. And then our final charts, I'm not going to spend as much time on these because we do want to leave some time for questions, but this is kind of more our, concepts. We're calling it wealth planning, but it's also different vehicles that you can think about investing in. And so this first slide that I want to show you here is just the type of account that you might invest in. So we talk a lot about the hows of investment in terms of starting early and stay invested and be diversified. But what kind of account should you open? And so there's kind of a range of possibilities here. One, you can do it yourself. So you could open up, a Schwab, Fidelity type of account and be in charge of the investments yourself. You got to find the investments. And when that bear market hits, you got to make sure that you stick to your plan and keep yourself invested. And obviously the good news here is that that's going to be the cheapest option. You don't have to pay anyone except for some of the investments that you make. If they're in mutual funds, there will be expenses associated with that, but you're not explicitly paying a person to do that. The stockbroker is the next two lines are kind of merging together, which I won't go into all that, but think of the stockbroker as a relationship that you might have, and these can be available even the Schwabs and Fidelities of the world, I think, but it would be kind of a collaborative relationship where you're kind of suggesting some investments and bouncing it off of someone, and they may give you some ideas back too. So kind of a collaborative back and forth. And then the far category here would be wealth manager, where you're still very much a part of it. You need to make sure that that in this case you're going to turn your portfolio over to someone else to manage. But even there, that person really needs to understand what your goals and objectives are and how you're going to, how to create a portfolio that best suits your particular needs. And the couple things that I would say there is, if you do go to someone, whether it be a stockbroker or a wealth manager, don't be embarrassed about your lack of knowledge about investments. And the way I think about this that is probably appropriate for today is, I have a dog named Piper, and if I take Piper to the vet, I don't expect the vet to think that I know everything about the best way to take care of a Bernese Mountain Dog, which is what Piper is. So if you go and talk to a financial professional, their assumption shouldn't be that everything about finances. So just ask as many questions as you possibly have. And then the other thing too is also ask about fees. Certainly don't be embarrassed to ask about fees. I mean, you're entrusting someone to manage your hard-earned money, and you deserve to know what the fees are. And recognize that there can be different kinds of fees. Sometimes when that question is asked, some people, advisors out there will just mention advisory fees, but there are other fees as well. There's fees that come from investing in mutual funds. So what you're looking for is, what are my all-in fees, based on the things that I'm investing in, plus if there's any advisory fees on top of that. It's really important to know that, and you deserve to understand that. Okay, and then the next page just gets into wealth management. Obviously, we do a lot of that here around William Blair, and there's a lot of different things that a wealth manager, as time goes on, will get involved in. And here are some of the different categories that we think about with people, and you can kind of see them all there. So they're all really important. It gets pretty complicated over time, and that's exactly what you want to have happen. Is you want to build enough wealth where it gets complicated, and then all of these things are a consideration. And then the next page again is just another way to think about your investing lifetime and some of the things that come into play here, whether it's becoming established early on, and then you kind of go through a phase where you're building wealth, your portfolio is getting a little bit bigger, but you're still contributing money into it. And then you get to a point where it comes time to think about preserving wealth a little bit more, and then ultimately looking at some wealth transfer ideas, especially if that's part of your goals and objectives. And then this next page I just put in here because of the circle. So because I like the view of the circle, which is that you always kind of have to monitor this stuff going forward, and it's really important to do that. So while I sort of argued for sticking to your plan, well, individuals, a lot of things can happen in our lives, and so it can impact what our goals and objectives are. And so, when I say stay invested, I'm kind of thinking more investment philosophy, but things do happen in your life. And so it is important to go back and make sure that, you're implementing the right thing, you're adapting to what's going on in your life, that you're understanding what's going on in your life, that you're designing that good plan. So I like the circular depiction because I think it's important. Okay, and then finally we get to the last slide, which is to say the kinds of accounts that potentially we would be invested in. And so, I would say just a couple things here. First of all, if you work at an organization where they are offering, something like that allows employee deferrals of money, like a 401k or a 403b or a 457b, you definitely want to take advantage of that, because the ability to avoid some taxes now and grow your money for the future is really quite powerful. Where you really want to make sure that you take advantage of this is if you work at a company and an employer is offering some matching contributions, or in some cases contributions that they're not even matching anything. You do not want to give that up. Make sure that you don't give up free money. And that may seem really simple, but the consultants have studies out there that show there's a lot of Americans out there that are eligible for plans where they're going to get free money and they don't participate, which is almost enough to make me cry. That's terrible. So make sure you take advantage of that. The other thing you can do is traditional IRAs. So there's a limit to how much you should contribute a year to those, but you can take advantage of that and get a tax deduction now. And then there's these things, Roth IRAs, which you don't get a deduction right away, but then you're able to grow your money tax-free and take it out tax-free. So that is an extremely powerful tool. And with those, going back to the 401ks, there's even this, it's been around for several years now, but there are such things called Roth 401ks, which allow you to kind of create a Roth money in your 401k, which is especially helpful for those folks that may not be eligible to contribute to a traditional Roth IRA. So again, you don't have to understand all that now, but just throwing that concept out at you. And then if all else fails and none of these is really eligible to you, the other thing I meant to mention too, especially for a lot of folks on this line, SEP IRAs is something also to look into. So if you don't participate in a company that has like these traditional 401ks, or you're a smaller practice, you might want to, use a SEP IRA too. That's another one to think about. But if all of those fail, just having a plain old taxable savings account where you're making investments, you're going to have some tax consequences to that, but that is certainly better than not investing at all. So, consider that as well. So with that, I think that is it, Anna. I hope I didn't go too long, but that's the presentation.
Well, excellent. No, you did not go too long, and thank you so much, Mark. I learned some things myself, and I'm feeling a little bit more optimistic about my investing future. So thank you. We definitely have some time for questions. Real quick, I just wanted to highlight 2 more co-sponsored webinars with AVMA Life. Again, we're very grateful for their willingness to co-sponsor with us here. In January, we're going to be talking about millennials. And you may be wondering, why do I really need to know about this, or what do I need to know about them? Well, the answer is that you do need to know about them, or better understanding millennials can really help in your practice, since millennials right now are one of the biggest groups of pet owners, and they are certainly one of, typically, they make up a very large portion of veterinary clientele. So understanding a little bit about how they think, what they value, what their insight is, can really help you build those relationships with them, and then, of course, therefore, help them really connect to your practice. So that's what I'm really looking forward to. I've heard rave reviews about the presentation. And then in April, we're going to be a presentation from a physician with the American Foundation for Suicide Prevention, to really help us understand a little bit more about some of the mental health issues that we need to think about from a veterinary perspective, and dive more specifically, of course, into suicide. I know that sounds like a little bit of a deep topic, but I think it'll be actually very good, especially for veterinary professionals, veterinarians, veterinary technicians, those of us in this field, because we know that this is something that's been a big issue for veterinarians for many years. So I wanted to leave you with a couple of things. Here's contact information for Libby Wallace, who you heard from earlier, and general contact information for AVMA Life. And then the last slide here is just, again, some reiteration of how you'll get your CE certificate. So fear not, we will get that emailed out to you, but I will draw your attention to point number 2. If you are watching this in a group, so you weren't the one registered and signed in, then we do need you to send the name of either your name or the names of everyone in the group along with their email addresses to us within 24 hours. And once we receive that, we'll issue individual CE certificates to everyone else. So, all right, Mark, well, let me pose some questions to you here. So as you understand, certainly veterinary students were strapped with quite a bit of debt. So not surprising to you, but we had several questions from vet students who are either currently in school, so their loans are being deferred and they're not paying interest, or some who are just freshly out of school who may just be starting to pay interest on those loans. So typically you have a 6-month grace period from graduation. And the question is, when thinking about where to spend your money, now you finally have a little bit of an income, should they really be focused on paying off those student loans as fast as possible, or paying more on the loans than they might otherwise pay over a typical 30-year repayment plan? Or especially if you have other big events in life coming up, like a wedding, or you really need to get a car, what's some good advice to really helping create your budget specifically with respect to student loans when you're in your very early years?
Yeah, so I think generally speaking, what we want to do is make sure that we understand what the interest rate on any loans that we pay are. So I had referenced early on, I think one of the big evils out there is credit cards. Those carry very, very high interest rates, and those are ones that you just have to prioritize getting rid of. And so that's a big thing. But then even on your student loans, you want to look and see what the rate is. And so when I think about, I'm kind of going back to my presentation. I mean, if we think about, should I put dollars aside for my investment portfolio when I have loans outstanding? Does that make sense? Well, again, if our students are following that more aggressive asset allocation, then typically over time, their returns are going to be probably a little bit better than their interest rates that they're paying on their student loans. And so it does make some sense to probably put some money aside. But I think with any loan that you have, you want to be on a pattern where you're paying it off. So you definitely don't avoid any loans that you have. You want to be on a cycle where you're going to see those balances go down. The credit cards are especially important, though, because the interest rate that you're paying on those is higher than what you're probably going to reasonably expect to get out of your investment portfolio. And that's why, those are important. And so I think at the end of the day, it's just a matter of prioritizing. I mean, unfortunately, we can't just, snap our fingers and create a bunch more money, which would make the answer a lot easier. But we can think about, if we start to think about the importance of maybe starting to create an investment portfolio and paying off our student loans, then when we also think about that car that we need, it may impact the kind of car that we're willing to get. Maybe we don't need as great a car as we really want early on, and we can get that better car later when we have a little bit more disposable income.
Excellent, thank you. Now, here's a good question. Is it a bad idea to start investing in the market right now since it's at record highs? Which meaning, right, the old adage of property, buy when prices are low and sell when they're high. So what do you think about that?
Yeah, so that it is a great question. It's a really good question. And so I think that this is a good time to start. I would agree that the valuations of stocks are high today. They're not as crazy high as they were back in that 2000 to 2002 bear market that we had, that technology craze that made stocks peak in the year 2000. Those were some really high valuations. These ones are higher than average. So I certainly wouldn't sit here and argue that stocks are cheap, but you just don't know. I mean, there are also things where we are seeing some signs of the global economy acting in concert with each other, sort of doing a little bit better here. We think that companies' earnings are going to be a little bit better next year. So the stock market definitely can continue to go a little bit higher. But the beauty of getting going is that, especially when you're young, is you start putting some dollars aside. And then, at first, you're not going to have a big portfolio. And so, if you run into a big bear market and some of those initial investments turn out that they kind of go down on you a little bit, guess what? When the value of the stock market goes down, if you're still investing money, you're going to take advantage of those valuations there with your new dollars coming in. And so I still think that it is more important to kind of get going. And one thing I would mention is just myself. Now, obviously, I'm a finance guy, and so I'm a little bit more into this than the average person, but I've kept a spreadsheet my whole working career. And so I have my 12/31 valuation for every single year that I've worked. And that's kind of a fun thing to do because, there were ugly years in there. I was invested in those two nasty bear markets, and that part isn't very fun to look at. But what I can see over time is those dollars that I've put to work have gotten a little bit bigger over time too. So that's something to also think about.
Excellent, thank you, helpful. Here's a question from someone on the opposite end of the spectrum, not a new grad. So this person says, I graduated in '93 and I'm still paying on my student loans. I owe approximately $22,000. Is it smarter to borrow from my 401k to pay off the loan or not, or continue status quo?
Let's see about that. I generally would say no. I mean, this would be one where I'd have to kind of sit down with the person and really see a better picture of the entire, everything that they had going on. There are loans available for 401ks. They typically have a maximum that you can take out. But unless you're buying your first house, they're typically only available for 5-year increments, which means that the monthly payoff amount is relatively large. And the reason why they're set up that way is not to make it hard on folks, but the point of the 401k is not to give you a place where you can borrow money. It's really meant to be for your long-term savings. And so to the extent that you would have to borrow out of it, the plan is asking you to kind of get that money back in sooner rather than later. That's why they have those short time frames. So I'd assume that if there are, this person has 22,000 of loans outstanding, they're probably making some payments on them. So if you go now and borrow from your 401k, now you have another big payment that you're going to be making. And rather than doing that, keep that money in your 401k, let it keep growing, and whatever money that you're going to use for the 401k, or maybe not even to pay off the 401k loan that you were going to take, just use that to increase your monthly payment against your outstanding loan, I think would be a better path to go here.
Excellent. Well, Mark, if you have time for a few more questions, there's a few more that I think are pretty worthy here.
Sure, let's do it.
Okay, so how about some just general advice about the best, when you're looking for either a broker or a wealth management firm, what kind of questions should you be asking them? I know you already talked about asking about fees, so I think we've covered that, but what are some strategies to help those of us who don't know this world start to get into it and find a group that we think is good quality, trustworthy, et cetera?
Yeah, so that's a great question. So there's a couple different things that you can do there, which is, one thing that I would be cautious of is, obviously I've been in this business a long time. I've had situations where, we're up against another firm. And one thing that amazes me is that a lot of individuals and firms out there, they are very, they really enjoy talking about themselves, and they like to talk about how great they've done and how great their firm is. And that concerns me. You definitely want to hear about the firm because you want to hear about the firm and the culture that you're going to be working with. But what's also really important is that person is asking about you, that they get to know your situation, because, you don't want to just be another number client in that firm. You want to think that they actually understand your specific situation. So the one thing I would, look at how you're being interacted with. Are they asking you questions? Are they, really getting, involved in sort of your financial life and making sure that they're trying to figure out where the match is between your situation and their firm? So, and you would be surprised at how many firms that will knock out, because again, there's just way too many out there that kind of are going to try to sell you that they have it all figured out, and they really don't. It's a tough business, but it's really important that as we get clients that we understand their specific situation. So that would just be sort of one general thing to look out for. And then, beyond that, I would, you can ask them really anything. I mean, that's the biggest thing is just don't be scared to ask questions. But, how long have they been in it? What are their credentials? As the bio that was read about me in the beginning, I have a chartered financial analyst. That's a different designation than someone that just has a Series 7. And a Series 7 isn't an easy thing to get either, but that's a different level of certification that I have and that a lot of other people have too. So that would be something that would be interesting to know. What kind of schooling do they have? Did they just get a bachelor's degree in English? If they did, that doesn't mean that they can't be really good at this profession, but, maybe that's something worth trying to at least ask them about. Hey, you only have a bachelor's degree in English. I don't see any business degrees in here at all. So how is it that you made that transition? How long have they been doing it for? So that is definitely something, because I remember when I started in the business, people said, yeah, you're doing okay, kid, but you've never been through a bear market. You've never earned your stripes. And so, have they seen a really nasty bear market? What did they do with their clients when that happened? That's a completely fair question. There really are no questions that aren't fair. So hopefully that gives a couple of ideas, Anna.
Yes, it does. No, I think in some ways it sounds like looking for a good veterinarian. So yes, these are things that, great questions. I appreciate it. All right. Well, at this point, I do appreciate that we're 10 after the hour, and I know there are some questions that we couldn't get to, but thank you very much, Mark, for taking the questions that we did have. And thank you for everyone who attended today. I hope, like me, that you definitely learned a few things. You're now past your intro to investing and able to go out and do a little bit more, be a little bit more knowledgeable and take that knowledge forward. So again, Mark, I can't thank you enough. We so appreciate it. If there are any questions, again, for Pet Poison Helpline specifically, you can contact us at info@petpoisonhelpline.com, the email address that you see on the screen. And then there is, of course, contact information for AVMA as well in the slide previous. So with that, everyone, thank you for coming and bid you a good day. And we will be hopefully seeing each other again shortly for another webinar. Take care, everyone. Bye-bye.